Welcome, everyone. I'm Kathy Minahan. I'm the president of NACD New England and the former chair of, actually, the former CEO of the Federal Reserve Bank of Boston, which is relevant for this discussion in that we are talking about digital currencies. Thank you for joining us at today's fireside chat. I have no doubt that this is going to be a fascinating discussion. A couple of quick announcements. First, we'd love to see your faces. While we have the speakers spotlighted for portions of the program, we encourage our members to use their video when possible. Next, we ask that you remain muted throughout the program and use the chat function to pose questions. No need to wait until the Q&A portion of the event. We will monitor the chat box during the panel discussion. Now, I would be remiss if I did not thank all of our chapter sponsors. I think we have a sponsor slide, do we, Deb? There we go, our chapter sponsors. They are an unbelievable group of organizations. Their loyalty underscores the important role of NACD. It's their support that allows us to fulfill our mission of delivering world-class, director-centric, local programming and peer-to-peer sharing of insights that's absolutely vital to advancing excellence in the boardroom. Today, we are highlighting two very loyal sponsors who have continued to support us through these challenging times. Our spotlight sponsors today are KPMG and Hinckley Allen. Our last announcement before the program is a reminder to let us know your thoughts on the program. Shortly after we're finished, you're going to receive a survey from Deb Rosenthal, our executive director. As always, we ask that you fill it out. It will take no more than 3 minutes, I promise, and will greatly help us as we develop upcoming programs. And now I'm so pleased to introduce Teresa Hillary Clark and Jim Cunha, our fireside chat participants. Teresa has an extremely interesting background. She has deep experience in financial services as a former managing director at Goldman Sachs and in the investment banking division. Teresa holds many board seats, and prior to her current roles in the FinTech sector, Teresa was chair of Change Financial, a company that developed a cryptocurrency in the Australian market, actually quite recently. She's currently the chair of Africa.com, a media holding company with an extensive array of platforms that reach a global audience interested in African content, and community. Teresa's on the board of Gallagher, the Leadership Council of Women Corporate Directors in New York, and is a member of the Council on Foreign Relations. And we're just thrilled to have her today at our fireside chat. Now let me introduce Jim Cunha. Jim is an old friend from the Federal Reserve Bank of Boston. It's great to see his face on the screen. He's the Executive Vice President of Secure Payments and FinTech Research at the Federal Reserve Bank of Boston, where he's worked since 1984. His entire career has focused on the interrelationship of payments, security, technology, and innovation. He leads the Federal Reserve's secure payment efforts to reduce fraud in the US payment system, an incredibly prevalent thing in our payment system and something that we all need the Fed to work on protecting us from. In addition, Jim spearheads the bank's efforts, the Federal Reserve Bank of Boston's efforts to study distributed ledger technology, or as we all know it, blockchain, to determine its potential benefits and risks. He's specifically focused on the evolution of the technology and its potential impact on the financial services sector. As such, he's responsible for technology research related to CBDCs. Central bank digital currencies. The reason he joins us here today. Currently, the Boston Fed is participating under Jim's leadership in a joint research effort with MIT's Digital Currency Initiative. Wow, this is going to be some program. Experience, background, theory, technology, we've got it all here. Welcome, Teresa, or rather, I should say Teresa and Jim. Teresa.
Well, thank you very much for that kind introduction. I know that you've known Jim for some time, and I've only had an opportunity to get to know Jim in preparation for today's session. And I just simply want to say that I am absolutely tickled to be able to have this conversation with him. I think it's fair to say that Jim is probably the leader in this country in understanding how the United States dollar could turn into a digital currency. And just put in simple terms like that, I think that really puts his expertise squarely on the table, and why we're so fortunate to have this conversation with him today. Now, we're having this conversation in the context of NACD. And so we want to make sure that this conversation is oriented towards serving the members of NACD by helping you as board directors of both public and private companies understand the relevance of this to the companies on whose boards you serve. We want to make sure you understand the strategic opportunities for the companies that you serve, and we want to make sure that you understand the strategic risks associated with digital currency. And really, as the headline, the title of this program says, it's becoming more mainstream. And so in the past, many thought that this was just something that maybe your nephew was trading on his laptop at night on Bitcoin. But how is it coming into the mainstream? How is it coming into the boardroom? How is it relevant to you? And what is it that you need to know in order to be a good board member around this topic? So that's what we're here to do today. And so we're going to have a fireside chat. And then at the end, there will be an opportunity for Q&A. So Jim, thank you again for being here.
Thanks, Teresa. My pleasure to be here. Especially, I did speak to this chapter, I want to say about 4 years ago, on blockchain specifically, and it was a great set of questions I got then. Unfortunately, not in person, but looking forward to the conversation and the questions.
Good. So I've got some questions for you, but before we start, Jim, let me just ask you this, the question. We're talking about why is this relevant for board members? Can you just say a word or two before we get into the meat of today's presentation as to why board members should be caring about this topic today?
Yeah, I think if you look at it from a couple perspectives, first of all, the role has to do with understanding the opportunities, the business risks for the corporations that they serve on the boards. And I liken it to the early days of the 90s when, people were thinking about this internet thing and the World Wide Web. And, many companies weren't involved with it. But if you thought 3, 4, 5 years out, it did become something strategic so that every company has some presence on the web, uses the internet. Same with going to the cloud. Going to the cloud at one point was not in the future. But if you think about it, it's become, a cost efficiency goal, resiliency. So I really think if you look at IT as a part of the strategic value of a company, I put this in the same vein. How we move money, how we move it digitally is really important from an opportunity perspective, from a risk perspective, but also from a competitive perspective. So I think of it in that same, next 3 to 5 year time frame, which is where, boards should be thinking.
I think that analogy is particularly appropriate, understanding how the internet may have started off seeming like a fringe activity and now is part of our mainstream. And so I think that that's why we need to pay attention today. So thank you so much. Okay. I know you have some slides you're going to share, so we can start teeing those up. And let me tell all the participants today that NACD will be distributing Jim's slides, so you don't have to feverishly take notes. It's a great set of slides. I've seen them, and I'm sure that you will want to keep them and reference them, so you will have them. So let's start, Jim. What is digital currency?
All right, so go to the next slide. Let me say 2 things first. Normal Fed disclosure. These are my words, not necessarily the words of the Federal Reserve System or Kathy as our former CEO. But also I want to encourage the members of the audience. I leave myself open to being contacted after this. If you have questions, if you want to come to me, I always leave an open invitation to send me your questions or set up time for a conversation. This is a very complicated set of things, so I want to make sure that we understand that. So if you think about digital currency, digital money, it really comes in 4 forms. We're all familiar with commercial bank money. People say that money is already digital, so why would you need a digital currency? And they're really talking about commercial bank money, where you move money out of your DDA account, et cetera, or through debit and credit cards. Then you have cryptocurrencies, so these would be Bitcoins, Dogecoins, or the other things you've heard in the press. These are private currencies. They're not owned by anybody. They're not backed by anybody. There's no government. There is no central authority. They're really created by the private sector and trade in a very open and public way. As you all know, because of the nature of them, the price does fluctuate dramatically. I think that Bitcoin is now, or was it about $66,000 per Bitcoin? When I first got involved with this, it was $25. So you can see that the volatility of the cryptocurrencies is something that is both a potential benefit or also a risk. So stable coins were developed because of the price fluctuations of cryptocurrency. What a stable coin is, it is a cryptocurrency, but is built in a way that it is pegged to a fiat currency, usually the US dollar. And what happens is, as money comes into the stable coin, it's basically put in a reserve. So the money, these stable coins, are backed by a basket of reserves. And those reserves are supposed to be used to liquidate in case people want money out of these stable coins. So it's really trying to give you the functionality of cryptocurrency, but the stability of the US dollar. We'll talk a bit more about that later. And then what I've been working on is CBDC, central bank digital currency. So what's different about this than a stable coin is it is a US dollar, or would be a US dollar. So it is a fiat currency issued by the central bank. It's a liability of the central bank. So that's how it's different from commercial bank money. And it can come in two forms. One is wholesale, so just think of it, real-time gross settlement, RTGS, or interbank transfer for large dollar values. That's the wholesale side. And retail would be everything else. We'll get a little more detail into that. If you go to the next slide, I'll talk about the other aspect of this, which is the technology itself. So we've referenced blockchain or distributed ledger. This is a very simple way of thinking about how does a regular system vary from a distributed ledger system. So on the left-hand side, what you have is, I'll use an example, the central bank has a central ledger, and each of those four entities around it are banks. So the Federal Reserve has the ledger of what money they have on deposit with us, one copy of it that we control. But then each of those banks has their own vision of what the money is. So they're trying to keep an accounting of that central ledger, but each one has their own idea of how much money they have with us. So the Fed's in the middle. If we want to move money, we get instruction, and the Fed moves the money on our ledger, and we tell the two banks what money's been moved. So that's a traditional hub and spoke system. On the right-hand side, you can think about this as distributed ledger. You've got four entities. There is no middleman. There is no central authority. And if you look at their ledgers, they're all the same. So they each don't have their own ledger. Each one has a copy of a single ledger so that each party can see all the balances of all of the accounts. And if they want to transfer money between them, they can just send messages to each other and then update the books. So that's an overly simplistic way of thinking about it. But you notice there's no middleman. You do notice that the data is all the same. And so that comes with benefits and risks, which we'll talk about later.
And so, Jim, before we go on to the next slide, let's looking at the difference between the left side of the page and the right side of the page. Just can you comment on the difference between Bitcoin and what you're talking about as far as a central bank digital currency? Is this the ability to have a central hub and disclosure and transparency? Is that one of the things that differentiates what you're doing?
Yeah, so what we would be doing looks more like the left-hand side, where this still would be a ledger, be maintained by the Federal Reserve, at least in the US context, because it varies, and that we would keep a ledger of who owns all of the various monies that are out there. So there still would be this hub and spoke with the Fed as the center. But as I said before, when we update the ledger, we're actually changing the hands of the money. So how the money moves is a little different, but there would be a central ledger controlled by the Fed. On the right-hand side, where you have Bitcoin, that's managed by people in the, basically the public. Anybody can help manage those ledgers. Anybody can help validate transactions. That's just not how the Federal Reserve would build a CBDC. We would still want to be in control and make sure it's safe and doesn't fluctuate.
And so that's a huge difference. And I think when we talk about mainstreaming, moving from the right side of the page to the left side of the page is an important aspect of what mainstreaming is about.
Yeah, absolutely.
Okay, so let's talk about what's going on around the world. There were some headlines a few weeks ago about El Salvador having been the first country in the world to adopt a central bank digital currency. I know that that's one thing you mentioned, but there seems to be a lot more than that going on.
Oh yeah, an awful lot. And if you go to the next slide, we'll talk about some of the significant countries, but this is only a piece of the puzzle. I believe there's something like 84 central banks that have been studying retail CBDCs. Once again, this is the one where it'd be used by individuals and businesses. China is the most advanced. They're actually in a production pilot in, I think, 10 different cities, and they've already moved millions of dollars on their system. Their goal is to have it up and running for the Beijing Olympics in 2022. The Bahamas and the Eastern Caribbean Bank are also in production. They have a production system since October for Bahamas. Sweden's unique. Sweden has been looking at this a long time. The real message here is that CBDC is not homogeneous. There's not one way of doing it. There's not one motivation. And there's also different risks and rules. Every one of these countries has a different regulatory environment, different legal structures, different norms. So if you look at the Bahamas and the Eastern Caribbean, they're doing it because it's really expensive to move money around the islands. So they have an efficiency play. Sweden, the paper corona, is barely in circulation. So they believe that the central bank should be in the currency game. And if it's not paper, maybe it should be a digital currency. Now, with the exception of the first three, nobody else has said they're definitely going to production. A lot of this is just deep research and understanding about what it would take if down the road in the future. And as you mentioned, El Salvador basically just declared Bitcoin as their legal tender. I think that was a rather desperate move, and people are just trying to understand what the ramifications are. If you go to the next slide, that just lists a few more countries. But as I said, this is just a sampling of what's going on around the world. You can see, most every developed country and many developing countries are listed here. And once again, for different purposes, though.
And if you had to say what the purpose is for the United States, what's the purpose of us doing it in the United States? We don't have the problems that some of these other countries had that you just mentioned.
Yeah, at this point, we haven't decided if we are doing it or not. But my job is technology. So my job is to understand what technology can help do this if we decide to move forward. If we look 2 years out and someone said, okay, let's start to think about this, we're 2 years behind. So our goal really is understanding the possibilities from a technology perspective. And then as some other things happen, which I'll talk about later, having to do with the policy choices. So right now we're trying to understand what is the business case in the US, but it behooves us to be studying the technology.
Before we move on, Kathy has a good question, which is, if the central bank is in the middle of CBDCs and holds all the records, then what is the role of the banking system in payments and settlement?
Yeah, that's one of the big questions on policy, which is is this something that would come right from the central bank to citizens, or would this go through intermediaries? So most of the central banks around the world are looking at what's called an intermediary model. Just like cash today, cash comes from the central bank, it goes to a bank, and that bank gives it out to its customers, be they businesses or people. And so most countries are looking at a similar model where the money would actually flow to the citizens through an intermediary, most likely a bank. However, I think it's important to note, we can talk about later as well, I think there may have to be other intermediaries besides banks. So you may find some non-banks being part of the distribution model to get it out into the hands of citizens, but banks will definitely be part of this process because they know the customer. And that's one of the key challenges of a system like this.
Is there any kind of first mover advantage or any reason why the United States would want to be seen as a leader and ahead of other countries in putting its CBDC in place?
Well, I'll quote Chair Powell, which is always a safe thing to do. He said, we don't need to be first, we just need to be right. So I think what's most important is people know that we're studying this deeply. We're not taking it lightly. Some people have been afraid because China has been first mover and is in production or a production pilot. And, I've listened to my own boss, I've listened to Chair Powell and the head of the IMF economics group, and they all say one thing people worry about is whether China will be able to take over the world as the reserve currency if they have a CBDC. And they all say no. The reason why the US is the reserve currency is not because we've got a really fast, retail payment system. With reserve currency, we have rule of law, we have deep capital markets, we have a strong banking environment. That's why the US is the reserve currency. So China being first gives them really little advantage when it comes to the reserve currency. So I don't think there's a significant reason that first is a first mover advantage has any real, important benefits.
Good.
But you don't be last. Yeah, you don't want to be last either.
We have a really engaged audience, which I think is fantastic. And so since some of the questions I see coming in are relevant to what you're saying now, let's not hold until later. Let me just go ahead and ask.
Yeah.
You may have seen that Rakesh is asking a question. He says, The Economist recently devoted an issue to this topic and advocated for a move to distributed ledgers for governments. What risks would you see if such a system were adopted?
The risks of moving to a CBDC, if I heard that correctly?
Let me get those words out again. What risks do you see if there were distributed ledgers for governments? That's the particular question.
Okay, I guess I'm not totally understanding. For a CBDC?
Yes, for a CBDC.
Okay, well, yeah. Well, I have some risks to talk about later, but any major change like this is going to come with benefits and risks. So if you think about some of the risks of digitizing the US dollar, one risk is if you get it wrong, or if you create a system that's inefficient or has problems with it, you create significant risk. But even if you do have a well-designed system, there's cybersecurity risks. It will be attacked by nation states that want to bring the US down. There'll be bad guys that want to create counterfeit CBDC. There'll be risks that people have their money stolen or lost. There'll be risks of the resiliency of the system. It has to be available 7/24, 365. It can't go down. You can't say, sorry, you can't use your money. So there's technology risks you have to think about as far as how you build it. I think those are some of the significant ones. But the other I would say is privacy versus catching the bad guy. So how do you make it as private as possible, which is a benefit, but still be able to do KYC, anti-money laundering, et cetera. So I think those are some of the significant risks that people talk about. One more is also, I'm not sure how real this risk is, but it's important to think about it, is if you create a CBDC, might there be a run on banks where people move all the deposits out into the CBDC? So I think that's significant to think about. I think it is a risk. I think it's something that can be managed, but I do think from the banking sector, and many of them are not strong on us issuing a CBDC at this point, you do have to worry about whether there's an impact on deposits, which also affect their ability to lend. So I think some of those are some of the major risks I would see.
Good. Well, thank you. So let's continue drilling down, Jim. Let's talk some more about what the Fed is doing with CBDC. You want to tell us a little bit more detail about that?
Sure. Okay. I'm sorry, Lisa. I'll mention one more thing. This is just what's happening around the world in wholesale CBDC.
Okay.
And I won't go into the detail here, but if there's any interest in the wholesale space, I'll talk a bit about this, but every one of these countries has some significant documentation on what they're building and why. So I'll just say for reference for later conversation. So if you go to the next slide, we can talk about what we are doing. And the first question is, well, why? Why is the Fed thinking about retail CBDC? I mentioned a few reasons. One, that China is first, and not that first mover means that there'll be a reserve currency, but it is important when other major nations are thinking about this. Facebook announced Project Libra, which is a private digital currency. Now it's called Project Diem. JPM has a JPM coin. Stablecoins are growing, Bitcoin. And so all these middle ones are, what happens if the private sector has control of the money supply and the central bank loses some ability to both manipulate for monetary policy goals, but also what if all these private cryptocurrencies out there? Most importantly, though, is the last item. In March of 2020, there were 2 bills introduced as part of the CARES Act. They weren't successful, but they would have directed the Fed to create a CBDC and make CARES Act payments that way. So even though they weren't successful, this just shows why the Fed has to be studying technology deeply in case a bill is passed that says build one. We need to be ready to answer to that charge. So go to the next slide. I'll talk about exactly what we're doing specifically in the Fed of Boston. We have a project called Project Hamilton. And I'd say outside of China, this is one of the most significant research projects in the world having to do with CBDC. So we're working with MIT, as Kathy mentioned in my intro. First and foremost, we have no plans to go to production at this point. This is research, but we're building a research model. We're building something that can prove and uncover issues with technology in the US context. And we're looking at it different ways. We have a couple of different platforms. So the first phase is to build a core engine. So this would be to make the money, to store the money and move it. And we've got some really aggressive goals. So we're talking about tens of thousands of transactions per second. We're talking about moving the money in under 5 seconds. Resilience so that no data center going down could ever bring the system down. So that's like basically the core system, and that's just the cost of doing business is to operate that way. That's complete, and we're about to issue the results with MIT sometimes over the course of the next month, and creating open source license for the code. So we're actually going to create a license for the code so that anybody can see it, anybody can contribute to it. The Fed and the MIT own it, but we're allowing anybody to contribute to it, because most systems today run by organizations, the underlying technology is open source in the basic part of the system, not the applications you buy. The next phase is to start to look at some really challenging policy questions, and there are a lot, to say, can we figure out how technology can allow us to think about these policy options differently? I mentioned privacy versus catching the bad guys. Can we think of new ways that the technology can make that maximize the privacy and still catch the bad guys? So that's where the technology really can bring us to new places and not just do things the old-fashioned way. So the other issue too is when you add more software in, you slow a system down. So the goal here really is to make sure we understand what's possible, building with the best minds that MIT has and the best minds that we have in the Boston Fed.
Now, this is an initiative of the Boston Fed. Are there any other Feds taking on a similar role, or are you taking it on for the nation?
Yeah, this is actually on behalf of the Federal Reserve System. This is not just Boston. There are some people that work out of the Board of Governors, and what they're doing is something called the Tech Lab, where they're looking at distributed ledger, but from a different lens. They're not building a CBDC like we are, but they are looking at technology, distributed ledger specifically, to say, how would you think about a CBDC that interoperates with another one? How would you think about this new technology for other financial services? So this is, I'd say, the deepest experiment, but we do have other people within the Fed that are thinking more broadly about blockchain types of systems and how they may be a benefit.
Good. All right. So let's move on to keep talking about. So for each type of CBDC, DLT, and stablecoins, what are the uses, risks, and the benefits? Can you walk us through that?
Yeah, and I'll go through this quickly. There's a lot of detail, but you'll have the slides. So if you go to the next slide, first we'll talk about retail CBDC. So these are the use cases we think about. Remember, it's digital. So it's not just a replacement for cash. It could be used for many things from top to bottom. Second to the bottom, I think those are really the person to person is the most likely, but also consumer to business, business to consumer. Their technologies allow you to walk into a store, point your phone, make a payment. That can be done with CBDC. Cross-border, theoretically, but cross-border is not just a technical problem. It's a really complicated set of problems. In business to business payments, probably the least likely, mainly because you need a lot of data that travels with that. And I like to say, if we built a CBDC, I think the innovation on top of it will allow for some really interesting future use cases, like, micropayments, not cost effective today, but could we do micropayments or Internet of Thing payments? Could you order your refrigerator, order your beer and pay for it at the same time, possibly? If you go to the next slide, we'll talk about what some of the benefits and risks of all those use cases. So one is cost. If you can eliminate cash handling, transaction fees, if you're a storefront today, and this is really just a cost efficiency for a particular organization, and you're paying an interchange fee today, and you took CBDC, well, maybe some of those costs could be reduced fast, as I said, under 5 seconds, versus some other forms of payment that may take hours or days to clear. Financial inclusion, one of my longtime passions is, can we use a retail CBDC to improve financial inclusion? And that's why I say maybe non-banks have to be participants. And then competition. If we build this, just think about the early days of the internet. People thought it was just bad guys and sharing pictures of cats. And it's turned into how business gets done. So could innovation on CBDC be of benefit? Some of the costs and risks, actually, some came up in an earlier question, but if you're an incumbent, could a CBDC create competition with new entrants? That's possible. Moving to any system creates transition costs. And I mentioned before, deposits of banks. So for CBDC, those are some of the high, major ones. Go to the next slide. On the wholesale side, we have really good interbank payment systems today. So a lot of the research that's been done saying that's not worth replacing with a distributed ledger type model. It really doesn't give you a lot of benefit. Wholesale cross-border, there could be, but it's still just not a tech problem. The real benefit for wholesale would be if you had other assets that were on blockchains. So some businesses and some big financial institutions believe that securities, derivatives, bonds will all be on blockchains. And so wholesale CBDC allows you to atomically swap the money for the security. You don't want the security to move without the money moving. And so this wholesale CBDC could potentially help that. The risks, this technology is new. Transition costs could be high. There's still a question about how do you interoperate all these new systems? That's always complicated, so there's a risk there. And once again, if you're an incumbent that moves securities and your business surrounds that, then this way of moving securities with wholesale could be competition for your business. So that's the wholesale side, a smaller set. But go to the next slide. I would say if people are in international businesses and they care about cross-border, there's an initiative by the Bank for International Settlement, which is central banks and treasurers from around the world. They have this analysis of cross-border and what's wrong with it and what will it take to fix it. So there's 19 building blocks here. So if cross-border is really a significant part of your business, I encourage you or the organizations you're on boards for to look at this work, because this is where some great benefits may come. I won't belabor it because there's a lot here, but if cross-border matters, this is an important set of initiatives happening across the globe. Go to the next slide.
Jim, before you go to the next slide, we do have a question about how foreign exchange would work. And so that might seem relevant to the previous slide. You want to just address how Forex would work, and would it be in the private sector or done by the central banks?
Yeah, I'm not an expert in that area. I'm more of the technology. So that's one of the areas that still has to be worked out is where's the FX and where's the FX risk. I will say one thing. There's some work done by a group of central banks working with the Bank for International Settlement. And they took 4 countries and were able to reduce the time it took to do a cross-border from 4 days to 10 minutes. So you reduce FX risk just by the fact that you're only taking 10 minutes. And they also reduce the costs in half. So they still haven't figured out the legal and the FX component of it, but just by reducing the time that it takes, you are reducing FX risk. So like I said, I'm not an expert in that area, but I think that's still designed into the system. Yeah.
Good. We'll let you get back on track here.
Okay. I think they might have took back one slide. I think they may have skipped. Or maybe it's, okay, I'm sorry, you're on the right slide. So if you think about distributed ledger, I mentioned some of these cost, elimination of middlemen. So middlemen mean cost. Speed, some of these ledgers can move. Things like Bitcoin today takes minutes to move. Stablecoins take little time. Also transparency. if everybody can see the ledger, you don't have to reconcile your book against the bank. You can see the balance and know at real time what the balance is. And by definition, distributed ledgers are distributed copies of the data. So there's a resiliency benefit there since the data is already replicated. There are some costs and risks though. Remember the Federal Reserve as the center for wire transfers? You trust the Fed. You don't trust the other banks. You trust the Fed to move the money. If there is no central authority, if there is no Fed in the middle, you have to figure out new trust and legal models amongst all those participants. Technology is still fairly new. Throughput is slow for most of these systems. Governance, in some of these systems, the governance, the decision makers are the people that write the code and validate the transactions. In Bitcoin, it's called a miner. So there are risks to governance when you aren't in charge of the actual network. And then privacy. If the data is visible, might it be visible to others? If you go to the next slide, we'll talk about some of the benefits or some of the use cases. So obviously, we already talked about distributed ledger, cryptocurrency, stable coins, cross-border, interbank settlement, but also stocks, bonds, derivatives. There's significant work out there to put exchanges, to put securities, to put other things on these distributed ledger systems. What's interesting is a digital claim on a physical asset. There is a company called Everledger that keeps tracks of diamonds. So you say, okay, what's the benefit of that? Well, now anybody, the buyer, the seller, anybody can trace that diamond back to its origin and say, is this diamond from a conflict zone? And if it is, I don't want it. Art. You can prove art by being able to trace the art in a distributed system that you can see the origins of the art and how it's been bought and sold. So it's really for validating the source and validating the authentication of these particular assets. I'm not a trade finance expert, but I've heard it's expensive. It comes with lots of paper, a lot of steps. And trade finance is a huge area of development for distributed ledger. Supply chain. Walmart has been basically tracing pork in China through supply chain. And you may say, what does that give you? But it gives you visibility. I heard a case, you all remember, I don't know, 8-10 years ago when all spinach was taken off the stores of, the shelves because there was an E. coli issue. Well, they couldn't trace where that spinach had come from. So the only thing they could do is take all spinach off all shelf stores in the entire US. So talk about a cost and how supply chain being able to trace that spinach back to the farm would be of value. And then distributed finance or DeFi is a way of, connecting people that have money to lend with people that want to borrow it, usually without financial institutions being in the middle. So you may have an opinion about what's good or bad there, but that's an area of focus for distributed ledger. And one more slide. This is getting to stable coins, and this gets a little more challenging, but basically the benefit of stablecoin is it's cryptocurrency, but stable value. They're backed by reserves, but a caveat, those reserves may be different things. In some cases, it's US dollars. In some cases, it's commercial paper. In some cases, it's receivables. So they're not all as liquid as others. It's really important to understand that. These are all built on a blockchain called Ethereum, and I'll explain why that is an issue later. And right now, the fees are very low to move stable coins. So those are all benefits. Use cases. Most cryptocurrencies are actually bought and sold with stable coins. It's really hard to move money out of a bank account and to buy a cryptocurrency, especially in large dollar volumes. So they use stable coins for that. I mentioned DeFi, cross-border. If I have a stable coin and I want to give it to Teresa and she's someplace else, I can do it seamlessly without any financial institution being involved. So it's really easy for one person in one country to give it to somebody else. If you want to hold US dollars and just have that pegged because you're in Venezuela and you're in hyperinflation, you can do it there. But I will say it has very limited use for payments, either retail payments or even wholesale. It's really used primarily today for buying and selling cryptocurrencies and to hold the US value. Go to the next slide, I'll talk a bit about the risks. I mentioned that the reserves that back these cryptocurrencies may be different. So you do have a run risk. If everybody wants their stable coin and you've got to sell all those assets, you maybe have to sell them at a fire sale price and you won't get your full dollar for them. These assets are held in custody. So is there a risk with the custodian? And if you don't know what's in the reserve, if it's not publicly disclosed, then you have a risk that that money isn't all backed. If you've ever heard of Tether, the Tether's been in the press for lying about the reserves and not having the reserve exactly what they said. Also, regulatory uncertainty. The SEC Commissioner Gary Gensler, my own boss, and the Chair Powell have said, if you have a basket of securities that are making money, and some of that money may go to the holders of these coins, it sounds like a mutual fund, but they're not regulated. So you may see some regulation coming out on stable coins, which does create, business model risk for them. And then if these stable coins get really, really, really big, you'll have systemic risk that these failing could have a contagion effect in the market. And the technical risks, it's too deep to go into here, but there are significant technical risks to stable coins that really most people don't talk about. So I would just say if stable coins are something that you are interested or your companies are interested in, just really make sure you understand the technical risks. It's not just the reserves, but there's significant technical risks in the underlying systems. The next slide, I think.
Before we leave stable coins, Jim,
yeah.
Beth asks a question about stable coins. So you've already addressed here on this slide the significant risks which may not have been fully appreciated. But one of the questions that she asks is, it seems as if CBDCs and stable coins are a huge step forward that might quell the volatility and predictability of cryptocurrencies. Do we see the rise of stable coins as spelling an end to some of the genre of cryptocurrencies that we've seen to date?
I think all these are going to coexist, stable coins, CBDC, and cryptocurrency, because people buy cryptocurrencies, in my mind, mostly for speculation. You wouldn't buy a stable coin because it's never going to appreciate. You wouldn't buy a CBDC because it's not going to appreciate. So I think it may take some wind out of the sails, but I still think that cryptocurrencies will exist because they exist today, in my mind, almost solely for speculative purposes. You hope they go up, and some other use cases, but mostly speculative. But I still think they'll all coexist for a significant amount of time. Okay.
Let's stay on this topic of policies. And so I think in the next set of slides, you might be able to talk to us about some of the major policy questions that CBDCs present.
Yeah, so go to the next slide. I have a summary of some of them. And I'll say that my job is a technologist, but I have to understand policy because policy impacts how you build a system. The Board of Governors is about to release a consultation paper that's going to ask for input on some of these important matters. They're not trivial. They have significant impact. And so these are some of the major ones we think about. I mentioned privacy versus traceability, privacy versus catching the bad guys. And these are at odds with each other. The financial structure, we mentioned, how is it distributed to the public? Through banks, through others. So these are all decisions to be made that will impact the systems that we're building. Cross-border security, huge security considerations. Now, monetary policy, some foreign central banks think about, can we use CBDC as a new tool? Can we put an interest rate on it? And we can raise the rate when we want people to hold it, and we can put a negative rate when we want people to sell it. Once again, my personal opinion is I don't see the US doing that. That's just not how we operate. The analogy I use is I don't explain to my 91-year-old mother why her CBDC is declining in balance. It just doesn't seem to be right for what we consider a public good, cash. And I do think, as I said before, financial inclusion, my belief is that CBDC, it should be declared that financial inclusion is a public policy goal. When you do that, you build it different. You may price it different. You may do things differently if that's one of your goals. So these are just a few of the many policy questions that will need to be debated before we even decide to move forward with the CBDC as far as production.
Can you drill down a little bit more, Jim, as to how CBDC creates greater financial inclusion?
Yeah, so what is a simple way? I always like to use this analogy. So take a single mother of three. She gets a paycheck. She does not have a bank account. So she has to take public transportation to the check casher, where she cashes the check. She buys 3 money orders to pay her bills. She sends money over remittances to her home country and gets charged $20 for $100 or $150 remittances. Those are all things that theoretically can be done with CBDC. None of that, none of the fees she's has to pay are needed if you have a CBDC that can give her a paycheck, that can pay her landlord, that could pay her things, that could help with cross-border remittances. And even if the CBDC itself is not the best solution, it'll drive competition, so some of the incumbents will act differently. It also gets into distribution. If it's distributed through a bank only, then by definition, people who are unbanked likely won't get it. So that's why I think some non-banks have to be distribution points. Some have argued the post office should be. I don't tend to agree with them, but that's another way of getting financial services to people who are unbanked or underbanked. So I just think these are a few examples of how we may be able to solve some of these problems, as I said before, especially if it's a public policy goal, that this is one of the things we want to make sure we accomplish.
Great, thank you. Okay, so given all this significant change, how does a director think about this?
Yeah, so I alluded a little bit to this. If you go to the next slide, I really think if you take yourself back to, just say you're a director in 1993, a lot of your spend is technology in the organization you support. They've got business models, they've got competition, there's cost efficiencies. And you think about, I've heard about this World Wide Web thing, this internet thing. And if you asked, the leadership of the organization, how are you thinking about this? I think it's the same analogy as to all these movements in money today. So I think you should understand what's the organization's understanding of FinTech and digital currencies in particular. If they don't understand it, they may not be able to, one, take advantage of it. Does the organization understand the potential benefits? Now, this varies if you're a bank that has more direct impact, but if you do a lot of international work, might the cross-border be a big benefit for digital currencies or stablecoins? So it may be new products, it may be cost efficiencies, but then do you understand the risk? So for example, if your organization was saying, we're going to buy stable coins, we're going to move all of our international payments to stable coins, I'd ask them, do you understand the underlying risk of technology that comes with stable coins? Do you understand the run risk of the reserve? So these are all questions that are significant and help get into the strategies of the bank, the cost efficiency of it. IT is such a huge component. And then it also, on the flip side, say, if I was in 1993 or 94 and an organization was going to dive all in on the internet, change their business models, change everything back in 93, I'd say, hold on, technology is not a panacea. Do you understand the regulatory environment? Do you understand how the technology changes impact your business model, your risk profile? Have you thought about the downstream effects of changing the technology? So I really see it in these major buckets that a board member should understand from a strategic perspective, competition. And then is the bank, so if that bank in 1993 said, no, we understand it, but we're not going full forward, I'd say, great. If you're in the year 2000 and that corporation saying the same things, we understand this internet thing, but we don't think it's going to take off, we're not going to embrace it, I'd say that that's a major risk to that organization, and most would fail to exist at some point in time, because you have to be connected to the internet. So an analogy.
Very good. Well, I think we've worked through that presentation very efficiently. Thank you. And we can now move on to some of the questions that have been building up. I see my mentor and friend, Pam Lenahan, is here. And Pam has asked a good question, as one would expect. She wants to talk about the heavy use of energy. And one of the big criticisms of blockchain is the high demand for energy and computing power. And is there any work being done to reduce the computer demands, including compression technology? And would a CBDC system be more sustainable?
Yeah, so we've all heard that Bitcoin uses the equivalent of all the power that Ireland uses in a year, or pick your country. The way Bitcoin works is that there are a bunch of mistrusted entities called miners that are managing the or potentially mistrusted, are managing the networks, they're managing the ledgers. And the way they build trust is through a competition. It's a very, very energy intense process called proof of work. And so it's the nature of Bitcoin and some other cryptocurrencies that create this need for all the energy. We would not build it that way because the Fed would manage the ledgers, the Fed would validate the transactions. So this proof of work that Bitcoin has to do, no central bank in the world would do. So it's not an issue. And if you think about distributed ledgers more broadly, many of the organizations embracing them would do the same thing. They would manage the network themselves and not rely on the public to validate the transactions and maintain the ledgers. So it's a non-issue for central banks. It's a non-issue for many blockchains that are being created in a closed environment by corporations.
Very good. All right. And then we're going to move on to a question from, or a comment from Allison. Might you dig a little bit deeper into the privacy versus fighting money laundering? She says, thank you for mentioning it already, and that there's a great opportunity if CBDC can, for CBDC, if this conflict can be solved. And I know that that is one of the important policy considerations that you talked about in some of your other conversations. So if you might just delve a little bit deeper into that.
Yeah, the way it works today is banks have to know their customers, and banks, through some legislation numbers of years back for good reason, are forced with checking for money laundering, checking for compliance against bad guy lists, et cetera, anti-terrorist financing. And so banks are charged with doing that. They hate it. It's expensive. I've heard there's 20,000 people in the US that work on just that job, and it's not very effective. And so if you think about it, might we be able to, because of new technology, handle that differently? Now, I don't make the decisions here, but I do think there may be a way of maximizing privacy and still catching the bad guy. There's technology in current cryptocurrencies. I won't get too deep into it, but there are technologies that allow you to examine data to see if someone's on a bad guy list or anti-money laundering checks, et cetera, but they don't have to actually see the data. It's something called a zero knowledge proof. I won't get into it, but there's a way of examining data and not exposing it to anybody unless there's a hit on OFAC or one of these other lists. So it's really a matter of, can we minimize the footprint of who gets to see the information and still catch bad guys? So it's a new way of thinking about solving the same problem. Otherwise, we do it the same way as we do today. The banks or other intermediaries would have to do all their own checking and have to do all their own KYC. And if it happens that way, that may be the outcome, but it's still a policy question that I think technology can help inform.
Okay. Good. And while we're on the topic of risks, Jill asks the question, open source is normally associated with being a huge cybersecurity risk. So how do you reconcile doing anything in this space with open source and not have it be a huge security risk?
Yeah, I think it seems intuitive that code that's open that anybody can contribute to might be exposed to bad guys putting stuff in there. But actually, if you look at it, most of us use Linux types of systems. Those are open source. The internet itself is built on open source technology. It has never been compromised or attacked in a way that compromises the underlying network. Bitcoin itself is open source, and no one's ever compromised the Bitcoin code. Because what happens when you have open source, what happens is, the saying is, 1,000 eyes make all bugs shallow, which means that if you have a lot of people looking at this code and contributed to it, then someone's going to see an error. Someone's going to see something embedded in there by the bad guys. And what usually happens is, if you look at the internet itself, so the internet's open source, but you run applications on top of it. So you may have your secret encryption or your secret way of communicating that is not the internet code, but applications on top of it. And so you can think about CBDC the same way, that the code is open, but if we actually issued a CBDC based on that code, we would add in some additional technology that would help keep it private, help make it such that you couldn't just attack the code and change it. So really open source is a way of getting more contributors to look at the code, contribute to it, find the bugs, find the problems, and then you add something in the end, which helps, prevent anybody from infiltrating.
Larry asks a question about political environment. How does the US political environment affect the rollout of any change to the current financial system in the US?
The same as it affects everything else. There are many views, and first of all, we have not decided whether we would or not. The chairman himself says he has to stay open to all sides, and that's right. That's how we should be doing it. And so you're going to get, different people with different motives that have different perspectives, and that's okay for them. Some that believe that a CBDC can help with financial inclusion, if a financial inclusion is a big part of their position. Like Senator Warren has been very open about that she thinks a CBDC can help with financial inclusion. Some banks are, legitimately worried about competition and flooded deposits. So they're going to be less positive on a CBDC because they have that worry. So I think what you have is, I wouldn't just say political motives. I just say people have different motives based on, their own profitability, their own weighing of what public policy goals may be more important than others. And those are starting to play out in conversations in Washington. So political to me just sounds like it's strictly one side of the aisle or the other, but I think there are some legitimate ways of thinking about this, to have the right debate.
Razvan asks the question, your slide with all of the developments in various countries around the world showed a wide range of initiatives. Which innovative approach of the many different countries has surprised you the most?
Well, I was definitely surprised by El Salvador, but I think that'll be a failed experiment where they actually adopted Bitcoin as their legal tender. I think this has, significant ramifications, but I think they were desperate. I think what's interesting is, I guess what I was not surprised, but really brought forward is every country's different. As I said, for the Caribbean, it's about moving money is very expensive. So they don't need the same system as the US. They don't need to process tens of thousands of transactions per second. China has whatever its motives are. Same with some of the developing nations. They may not have a strong retail payment system. So CBDC for them may be their first really national digital payment system. It's just like M-Pesa in Kenya. Kenya went from a paper currency to everybody has phones and people are moving money over these phones. So it wasn't a surprise per se, but just to see the variation and the fact that people are approaching it differently. But I think that's good. I think some central banks are saying distributed ledger is the answer. I'm saying let's research the technology and figure out what's best. But I think in the end, we're all going to be better for it because we're all sharing. Every central bank is sharing what they learn with everybody else. So I think that's the real magic of all this diversity. And I'm big on diversity from any aspect.
Great. Right, we've got another question from Kathy, and she says, stablecoins strike her as back to the future. That currency was once secured by gold, at least in the US. It was delinked in 1971 because of the amount of the hard asset available to restrain money and economic growth. Could this happen again?
Well, there is, I'll get broadened a little bit. There are some negative implications for stablecoins. And one is that you are taking that asset out into, keeping in the reserve, and does that create problems? So for instance, one of the assets that's used to back a lot of stablecoins is commercial paper. And that actually created supply constraints within the commercial paper market because it's all being bought and put in reserves. And so that's one unintended consequences of the impact there. Because gold was a physical asset and a physical asset with limits, I don't think we'll reach the same type of dynamic with stable coins, because any asset, commercial paper, securities, bank deposits, any of those could back a stable coin. So I think the basket of things that could back the stable coins are just not as limited as gold or silver as those standards. So I don't think the dynamics of the limitation of the physical asset will be a limitation. But there are, as I said before, there are risks with stablecoins that are real and I think significant.
Okay. Now, you talked in terms of your major design and policy questions. One of the topics you raised is the offline support. Can you talk a little bit more about what is meant by offline support and what could be imagined there?
Yeah, as I said, I think like paper currency, I think a digital currency would have to be have as much uses. So I can use my physical currency anywhere. But if I had a digital currency and the only way to use it was when I have a cell signal, then that limits its use. So if I'm in Hurricane Ida, or if I'm in a part of the Dakotas without range, or if I'm at home and I just don't have good bandwidth, and during the at-home school experience we've had with many of our kids, we learned that there are a lot of issues with bandwidth in the United States. So offline is supposed to solve a couple of problems. One, it should be usable when you don't have power, when you don't have a cell signal. So offline is to allow for those purposes. So that it's always 7/24, 365 available. So that's really the bottom line. Now you have to look at it both from a technology perspective. What does that mean to be offline? How do I actually get two phones to communicate in some ways so that I know that money is being transferred? Like ATMs today, if ATM's offline, they limit their withdrawals to limit the risk. So I think that it's a combination of the right technology to allow people to use it, but also how do you then reconcile after the fact and limit the risk that it exposes? So I think there's a business benefit to it. I also would think about, a CBDC like money should be available to anybody to use, fully accessible. So how about the blind? How about people who have physical disabilities? How about the aged that may not, know how to use the phone? So offline may be a way, or those technologies may be a way of expanding who can use it and when they can use it. So I think it's a cost of building it that we need to have an offline capability. It's just the balancing the risks and the technologies.
Okay. Let's talk about wallets. That's also another topic, a big topic that I know you're dealing with. And tell us what you mean by wallet strategies.
Yeah, so a simple way of thinking about it is if you have an app on your phone, Apple Pay or any of the payment applications on your phone, or your banking application on your phone, a CBDC, one of the channels is going to be an application on your phone, sometimes called a wallet. That may just hold your credentials, but that would be a wallet. Part of the question is, well, who creates the wallet? Does the Fed create the wallet and then it gets distributed by the Fed? Do banks create their own wallets? So how the wallet is created, how the wallet is distributed, how it's upgraded, all are significant issues. The central bank might issue a wallet, but most likely the central bank would develop minimum standards so that the security in the wallet is up to a particular level that we think it should be. If you have a wallet on your phone and you don't need any credential to open it up, that's not secure. Or if I can steal your phone and steal your money, that's not secure. So how do you think about the minimum security of that wallet, and then who distributes the wallet technology and how is it managed? So it's both a distribution and a user interface question as well. On the phone, that's one case, but you can also see cases where you may have a smart card as an access device or other things. So the technology may go beyond phones, but that's probably the main distribution.
How did you come up with the project name, Project Hamilton?
Great story. So I've got some very creative people working for me, and they're trying to figure out how to name. I wanted to call it Cunha Cash, but that didn't fly. Or Minahan money, as you may remember. We actually had a research project in Boston when I was working for Kathy that I called Cunha Cash, and she said, "I like it, but I wanted Minahan money," which we did. But that was back in 2003, if you can actually imagine. So my team says, this is a moonshot, right? So the analogy we're thinking about with China especially is this a Sputnik moment? Are we trying to, is this a space race? Are we trying to now keep up with China like we're trying to keep up with Russia? So they're researching different ways of thinking about that. So Hamilton is named, one for Alexander, of course, and the other is Margaret Hamilton. So Margaret Hamilton in the 60s ran a technology lab at MIT. and her team developed the guidance system for the Apollo space program. So it's more of a, in my mind, it's more of a nod to Margaret as it is to Alexander.
Okay, so another hidden figure.
Yep, absolutely. And we're working with MIT, so there's a correlation there as well.
That's fantastic. Well, if anyone has any more questions, feel free to put them in the chat. But otherwise, I think that we've had a very robust conversation and probably give people a few minutes back in their day, which I think people generally are happy to receive. You made this a power-packed hour, and I think edified us in many important ways in a very dense way. Thank you very much for your time, Jim.
No, my pleasure. They're great questions. I mean, as before in front of this group, there's always great questions, and these were right up there with some of the best I've had.
Fantastic.
Right.
Okay, so I'm going to turn it back over to Kathy now.
Unmute myself. You caught me by surprise there.
Sorry.
No, I, as evidenced by the Minahan money thing, have been really involved and invested and intrigued by the issues of payments and settlements for, I was at the Fed for 39 years, most of those 39 years. And I found this conversation extraordinarily provocative. The issues are significant, that any use of a new kind of currency, CBDC, stablecoins, whatever they're called, it has the potential to change at how we look at both consumer and wholesale payments, which can stand some looking at in this country, but more importantly, cross-border payments, which has been a difficult issue, particularly at the retail level, for years and years. For individuals trying to get currency to other countries without paying an arm and a leg to do it, having it safe and secure and used by their families in other countries is a really important effort. And this has, I think, the potential to help there. Some risks for sure. I've been intrigued by blockchain as well for a really long time. I think this technology is amazing, and it does provide a way to ensure that a set of accounts can be known by all involved with little risk that they are changed, and can act as a solid record. When you think of all kinds of transactions, whether they're real estate transactions or securities transactions or money transactions, having a solid record, it addresses a lot of old risks. I know it introduces new ones as well. So this conversation has been totally fascinating, and I was really appreciative of the focus on why a director should look at this. And I'm really glad NACD New England has addressed that question in this program. Sometimes directors, Teresa, I know you're on a lot of boards. I've been on a lot of boards. Sometimes you're so focused on the here and now, but this is something coming at us fast. And particularly directors of companies should be aware of it and where you might stand on the need to do things differently in the payment system. So I'm rattling on and on here. I couldn't help but want to say a couple of things, and I'm glad I had the opportunity to do that. Let me finish up with some quick announcements, and then you're all going to be on your way and save your minutes, as Teresa highlighted. I'm a very big proponent of that. The calendar for NACD New England is set through March, and we are looking at an excellent lineup. As a reminder, all of our programs are virtual through January, and then we hope to be moving to in-person programming in the new year. Although, if I were a betting person, I would bet that we will stay with some mix of virtual and in-person, just because the virtual does help you bring in excellence wherever that person or that organization might be across the country. On November 17th, we're going to discuss human capital, a topic no longer just compensation and succession. It's about the shift to the importance of your employees as stakeholders, part of the ESG formulation. On December 16th, we're going to tackle, oh my God, hold your breath on this one, disruption in the supply chain. I don't know about any of you, but if you've done any kind of home renovations, or in my case, trying to set up a baby shower for your daughter, it's amazing how delayed all kinds of things are because of supply chain disruption. It's not going away anytime soon, and our experts will help us to identify and mitigate the risks. In 2022, January 11th, we hold our annual proxy season preview. It's a joint program with the Philadelphia NACD chapter, and it's going to focus particularly on ESG. February 8th, we'll hold our first installment of our new thought leadership series, The Age of Disruption. The first program is based on technology. It's a good follow-up to this, and will be a fireside chat with Bhaskar Chakravorty, the Dean of Global Business at the Fletcher School and the Chair of the Council on Emerging Market Enterprises. And his companion in the fireside chat is going to be Corey Thomas, who is the CEO and Chairman of Rapid7 and also a board member of NACD New England. So that'll be fascinating. Also in the new year, our day-long programs for aspiring board directors, public board directors, and for experienced directors. Our programming committee, I can't say enough good things about it under Ellen Richstow's leadership. We continue to add opportunities to engage. So watch your email on Tuesdays for the list of upcoming events. As Teresa mentioned, you're going to get copies of Jim's slides. You're also going to get some articles, leadership articles on today's topics from our spotlight sponsors. And as always, you're going to get a link to the post-event survey. Your responses are very important to us. They help us design further programming that you will really want and need. So thank you all again for joining us. Stay safe and be well. And don't take too many CBDCs in the near future. Bye, everybody.
Bye.